Trading psychology is all about understanding how emotions like fear, greed, hope, and regret impact your decisions. Unlike many other activities, trading punishes emotional reactions. Greed might make you hold on to a winning trade too long, hoping for even greater profits, while fear can cause you to sell too early, cutting your gains short. For instance, imagine watching a stock you bought rise in value. Greed might convince you it will keep rising indefinitely, but then it plummets, leaving you with losses. Similarly, fear might drive you to sell during a temporary dip, only to watch the stock rebound moments later. The key to success lies in building a mindset based on discipline rather than emotions. Start by identifying emotional triggers that influence your decisions. Use tools like a trading journal to track how you feel during trades and notice patterns. Develop strategies to minimize emotional influence, such as setting predefined entry and exit points. Remember, trading success isn't about following instincts or gut feelings. It's about consistent, calculated execution of a well-thought-out plan. Fear is one of the most powerful emotions traders face, and it manifests in various ways. You might fear losing money, missing out on a profitable trend, a phenomenon often referred to as FOMO, or fear executing a trade altogether. Fear can paralyze you, leading to missed opportunities or rash, panic-driven decisions. For example, a trader might sell prematurely because they're scared of further losses, even though the market was about to recover. On the other hand, fear of missing out could cause someone to jump into a rally at its peak, only to suffer losses when the trend reverses. To overcome fear, preparation is key. A clear trading plan with stop-loss levels removes much of the uncertainty that feeds fear, as you'll already know the maximum amount of risk you're taking on. Additionally, reframing your mindset to accept losses as part of the process helps you avoid letting fear control your actions. Remind yourself that trading is about the bigger picture and long-term strategy, not short-term setbacks. Greed can be just as destructive as fear, if not more so. It often creeps in after a few successful trades, convincing traders they are invincible. This overconfidence can lead to reckless behavior, such as taking on larger positions, chasing unrealistic profits, or ignoring a carefully designed plan. For instance, you might hold on to a stock longer than you should, hoping to squeeze out every last dollar, only to watch your profits evaporate when the price reverses. Greed can also drive overtrading, entering too many trades without proper analysis, which increases the risk of losses. To combat greed, it's crucial to define your profit targets and exit strategies before entering a trade. Once you've reached your goal, stick to it and exit the position, even if the stock still appears to be rising. Consistency and discipline are far more valuable than short-lived, risky gains. By managing your emotions and focusing on realistic expectations, you can avoid falling into the trap of greed. Discipline is the backbone of successful trading. Markets are unpredictable, and emotions like impatience, frustration, or overconfidence can easily derail your strategy. For instance, revenge trading, where you take excessive risks trying to recover losses, often results in even bigger setbacks. Similarly, excitement after a winning streak might make you deviate from your trading plan, increasing your risk exposure. Building emotional discipline requires you to trust your strategy and stick to your plan regardless of external noise. One way to develop discipline is by practicing with small trades, risking only a small percentage of your capital. This approach minimizes the emotional impact of losses while helping you stay consistent. Additionally, using tools like stop-loss orders can help you avoid the temptation to hold on to losing trades. Over time, disciplined habits not only improve your mindset, but also lead to more consistent and predictable results, even in volatile markets. A trading plan is like a GPS for traders. It keeps you on course regardless of market fluctuations. It outlines your strategy, entry and exit points, risk tolerance, and financial goals. Without a plan, traders often find themselves reacting emotionally to short-term market changes, leading to impulsive decisions. For instance, someone without a plan might panic sell during a temporary dip, locking in losses unnecessarily, or buy into a rally at its peak, chasing gains that are no longer realistic. A well-structured trading plan removes much of this guesswork. It provides a framework for making consistent, logical decisions, even when emotions try to interfere. To create a solid plan, define your risk tolerance, set clear profit and loss targets, and establish rules for each trade. Review and refine your plan regularly to ensure it aligns with your goals. Most importantly, stick to the plan, especially during periods of market uncertainty. Losses are an unavoidable part of trading, but how you respond to them determines your success. Many traders fall into the trap of revenge trading, taking bigger and riskier trades to quickly recover what they've lost. This behavior often leads to even greater losses. Instead, treat losses as valuable learning experiences. For instance, after each trade, take time to reflect. Did you follow your plan? Was your analysis accurate? Or did emotions play a role in your decision? Keeping a trading journal helps you identify patterns and areas for improvement. It's also important to accept that even a perfect strategy will have losing trades due to factors outside your control. By focusing on long-term progress rather than short-term setbacks, you can maintain a positive mindset and avoid emotional reactions. Remember, every loss is an opportunity to refine your strategy and become a better trader. Herd mentality occurs when traders follow the crowd without thinking critically. It's easy to feel the pressure to join in when everyone is buying during a bull market or to panic sell during a sharp decline. But blindly following others often leads to poor decisions, like buying at inflated prices or selling at the bottom. Successful traders think independently, relying on research and analysis rather than crowd behavior. For example, while the crowd chases hype, a disciplined trader looks for undervalued opportunities or waits for better entry points. To avoid herd mentality, trust your own analysis and stick to your plan, even if it goes against popular opinion. Additionally, question why the majority is acting a certain way. Is their behavior based on sound data or emotional reactions? By developing confidence in your strategy and tuning out the noise, you can avoid costly mistakes and make smarter decisions. Patience is one of the most underrated skills in trading, but it's also one of the most important. Markets don't always move according to your expectations, and sometimes the best action is no action at all. Impatience often leads traders to chase trades, enter the market too early, or exit too soon, all of which can result in unnecessary losses. For example, imagine jumping into a stock that's already surged, only to see it reverse immediately after you buy. Practicing patience means setting clear criteria for entering and exiting trades and waiting for those conditions to be met. It also means accepting that not every day will present a good opportunity. Remind yourself that it's better to miss an opportunity than to take a bad trade. Over time, patience helps you make more consistent and well-timed decisions, giving you a significant edge in the market. Trading can be mentally and emotionally exhausting, especially during periods of high volatility. Without a balanced lifestyle, it's easy to burn out or fall into the trap of overtrading. Successful traders understand the importance of taking care of their mental and physical well-being. For example, regular exercise, healthy eating, and adequate sleep can help you stay focused and make better decisions. It's also important to take breaks from trading to recharge and clear your mind. Engaging in hobbies or spending time with family and friends provides a much-needed distraction from the stresses of the market. Additionally, sticking to a structured routine, such as limiting your trading hours, helps prevent overtrading and reduces emotional decision-making. Remember, trading is a long-term journey, and maintaining a balanced lifestyle is key to staying consistent and avoiding burnout. Trading is as much a psychological challenge as it is a technical one. Emotions like fear and greed can derail even the best-laid plans, while qualities like discipline, patience, and balance can keep you on track. It's important to understand that losses are a natural part of trading, and that success isn't about avoiding them entirely. It's about managing them wisely and learning from them. By creating a solid trading plan, controlling your emotions, and trusting your strategy, you'll build the confidence needed to trade effectively. Over time, mastering your mindset will lead to more consistent results and greater peace of mind. Remember, the ultimate goal isn't just to make money, it's to trade in a way that aligns with your goals, values, and mental well-being. Master your mind, and you'll master the market.